Thank you so much for joining us, Peter. We appreciate you taking the time. I need to start out just with this market movement we've been seeing. It looks like October is definitely off to a sluggish start. What are you making of the first couple of days of trading?
So I think there's two things that are important to me. One is I think we're overreacting to the JOLTS data. So I don't pay that much attention to the headline of the JOLTS data. I don't think that we have a good idea of how to account for the Indeed.coms and basically the fact that we do online advertising for jobs. So I think that number could be overstated. I think we have a lot of trouble with the seasonal adjustments. So if you look at the non-seasonally adjusted numbers, it wasn't so good. But really, I've spent a lot of time on the JOLTS in the past. I look most closely at the hire rate and the quit rate, and those are both back to 2019, even 2018 levels. So they're not showing the strength of the headline numbers. So I think there could be an overreaction. Having said that, I'm spending almost all my time now with customers and myself and my colleagues figuring out why do treasury yields keep going up every day? And it's very nervous right now where you're getting something wrong, because I thought we would stop at 440 and be back at 410. So I've been wrong on this. And we're all used to being wrong, but it's really difficult when you're wrong and can't understand why. I don't think the data supports 480 10-year. So I think we're all starting to look, have people lost faith in the government? Are all the antics out of DC now pushing us? What is going on? And until we see Treasury stabilize for whatever reason, I think this market's going to be weak because something smells off.
You know what? I want to peel back every single thing that you mentioned right now. Let's start first with just the conventional wisdom around the 3 to 6 months lag for monetary policy effects that you talked about. Now, why do you believe that this is an underestimate, and how does current economic context differ from the past?
So we had such a period of ZIRP that we've never really seen before. Not only were interest rates low, the Fed was buying, they basically squeezed everything out of the market. So I think you saw corporations take huge advantage of this. So when you look at what corporations did, they issued record amounts of debt in 2021 and even 2022. It's locked in at these low yields. So it takes a long time if you've managed that portfolio well. And I think it extends well beyond just what large corporations did. Individuals extended their auto loans. So the average maturity for auto loans extended a year to 2 years during the last couple of years. So people took advantage of high residual values, low rates. Look at mortgages. People locked in the rates. So although we've had this rapid rise in current interest rates, people locked in their borrowing. So it's taking much longer. We've only seen corporate average coupon go from 2.6% to 3%. So barely a 40 basis point rise. It will get to 3.5% sometime early next year. That starts to take a toll. So right now, it's only people who have to take on new debt are experiencing it, but the number of people facing that increases almost daily, weekly, and monthly. So I think we're going to see a year to year and a half lag effect rather than that traditional 3 to 6 month.
Now, are you saying
because people were very smart how they borrowed?
You know what? No problem. That's exactly where I was going. This is what you mean when you talk about smart borrowing.
Yeah, people took advantage of this, right? And again, it's at the consumer level. They extended those auto loans, mortgages, people locked in 7-year, 10-year, 30-year, right? No one was doing 2-year, 1-year ARM type thing. So people are very insulated from this compared to what we would have seen in prior cycles.
Absolutely. And so also, how significant, or actually, I want to skip over to the U.S. investment grade bond. Now, how does that respond, or the market's response to that, to monetary policies compare to the other major economies? Let me state that again for you, just so that it comes out clearly. When we look at the U.S. investment grade bonds market response to monetary policies, how does that compare to other major economies?
So I think we did a much better job generally in the U.S. of locking in these long-term rates. A lot of other countries rely heavily on their banking system to lend on the corporate credit side, and banks tend to be much more a 5-year and in. Our companies were able to issue a lot of bonds. You had a lot of 10-year, 20-year, 30-year. You even saw some companies issue 40-year bonds. So they were able to do a much better job, I think, than other country companies in terms of taking advantage of the U.S. bond market rather than relying on banks for lending, which is very good. Our economy still doing well. And now as rates have risen, you're starting to see issuance slow down. So they don't need to roll this debt. I think they're well insulated, and it's going to create opportunities for them as other places that maybe didn't hedge themselves as well or didn't do as much in terms of locking in long duration become exposed. So I think it's going to be a competitive advantage for U.S. companies or those who issued in the IG market. Sorry.
That's okay, pardon me. Given that extended lag and those smart borrowing strategies, what would be your advice to the Fed for the next 5 years?
I think they are supposed to be very cautious about hiking anymore. I think they're getting the message loud and clear from small and mid-sized companies who are seeing loans that may be rolled off at 6% and they're now starting to be charged 13%. If you had to go to private credit and you used to rely heavily on smaller regional banks, the small and regional banks are a little bit tight on lending right now. So there's lack of competition. So the amount that you're seeing your interest payments go up is very high if you weren't hedged. I think DC, including Powell, are starting to get that message. So I think they're going to be very cautious. And now they're seeing bond yields crack every day. They cannot afford a crack in the system. And the one thing they've learned over time, and I think they should have known beforehand, you can't let things that banks own get in much trouble because that puts pressure on the banks, which in turn puts pressure on the entire economy. So I think they should be very nervous about what they've done in the yield space and start at least sending some sort of message. Hey, we are cautious. We know people locked in rates, but we know those who didn't are facing much higher costs. It's starting to weigh on decision making. Let's give this 6 months to see where it plays out before we hike again.
Now, when you talk about the surge in the debt issuance back in 2020, do you anticipate a trend where corporations might try to deleverage, or will they continue to take advantage of any of the forthcoming lower interest rate scenarios?
Yeah, I think some will delever. I think they have this excess cash on the balance sheet. Many raised more money to have kind of quote unquote war chest. So I think you'll either see some deleveraging or you might start seeing some M&A activity, right? And we already saw, I think last week, one of the large tech companies took over a company. So they might start using that war chest to actually do some, accretive acquisitions, which could be really interesting for those companies and ultimately the market.
All right, we'll keep an eye on the M&A space as well as if companies deleverage. Peter Tchir, Academy Securities, thank you for joining us here on Schwab Network.